Financial apps promising early access to wages have flooded the market, and one name consistently stands out at the top of the search results for anyone desperate to bridge the gap before payday. Millions of people download these platforms daily, but a persistent skepticism surrounds them because the digital age is full of empty promises, hidden fees, and outright scams. Questions arise regarding whether these services actually deliver cash you can spend at the grocery store, or if they are just elaborate modern gimmicks designed to trap consumers in cycles of debt. Evaluating EarnIn requires looking past the marketing jargon and examining the mechanics of earned wage access to see how real money moves from an employer's ledger into a personal checking account. EarnIn operates as an earned wage access application rather than a traditional lender, bank, or payday loan provider. When someone clocks into work, completes shifts, or finishes a salaried period, they accumulate financial value that their employer legally owes them on payday. Historically, workers had to wait 2 weeks or an entire month to touch that capital, forcing them to rely on high-interest credit cards or predatory payday loans when unexpected bills arrived. EarnIn bridges that specific temporal gap by tracking the hours already worked and allowing users to pull a portion of those funds early. The money transferred to the user is not a loan, which means there is no interest charged and no credit check performed. Because the funds belong to the worker and represent compensation for labor already performed, the cash paid out is completely real, legal United States currency that can be spent, saved, or used to pay bills just like any regular direct deposit. The mechanism behind obtaining this cash relies heavily on digital integration and data verification. To use the app, a worker must download it, link their active checking account, and provide proof of employment and income. This verification happens through various methods, such as connecting a work email address, enabling GPS tracking for a fixed job location, or uploading digital timesheets. The app then syncs with the user's banking activity to monitor incoming direct deposits and calculate a daily maximum limit, which typically starts around $100 and can scale up over time. As hours accumulate during the pay period, the available cash balance inside the app increases. Requesting a cash out triggers a transfer to the linked checking account, and when the actual payday finally arrives, EarnIn automatically debits the exact amount back from the user's primary paycheck to clear the balance. A common point of confusion that leads people to question the legitimacy of EarnIn involves its fee structure, since corporate services rarely operate entirely out of goodwill. The platform does not charge mandatory interest or fixed subscription fees for standard transfers, which separates it starkly from predatory lending. Instead, it relies on a voluntary tipping model where users can choose to leave a small tip ranging from $0 up to a few dollars per transaction. Additionally, the company generates revenue through optional expedited transfer features. If a user chooses standard delivery, the funds arrive in a bank account within 1 to 2 business days completely free of charge. If they need the money within minutes to handle an emergency, they can opt for a feature called Lightning Speed, which incurs a small fixed transfer fee. These optional costs are entirely transparent, meaning users who avoid the instant transfer fees and choose zero tips can access their earned wages without losing a single cent of their actual earnings. Security and privacy concerns also shape whether users trust the platform with their financial data. Linking a personal checking account to a third-party application triggers valid alarms for anyone cautious about digital security. EarnIn utilizes bank-level encryption and tokenized payroll connections to interface with major financial institutions and payroll providers like ADP without exposing sensitive login credentials. Furthermore, because the service does not issue formal loans, it does not report payment histories or negative balances to major credit bureaus like Equifax, Experian, or TransUnion. Using the app or experiencing a delayed repayment does not directly damage a credit score, though failing to maintain a sufficient balance when the automatic debit hits the primary bank account can occasionally trigger overdraft fees from the user's personal bank. The primary risk associated with EarnIn is not a scam or hidden fee, but rather the behavioral trap of borrowing against future income. Cashing out wages early means that when the actual payday arrives, the incoming paycheck will be significantly smaller because a portion has already been spent. For individuals living paycheck to paycheck, relying on the app every single cycle can create a continuous loop where they constantly chase the next advance to cover past expenses, effectively creating a financial shortfall that is difficult to break. When used sparingly for genuine emergencies, the platform functions as an effective tool for liquidity, but relying on it as a permanent supplement to a low income can severely disrupt long-term budgeting. EarnIn provides real, spendable money backed by actual labor rather than virtual points or promotional credits. It provides a functional alternative to high-interest payday lenders by letting workers access the fruits of their labor ahead of schedule without facing punitive interest rates. While users must remain mindful of optional speed fees and the potential cycle of early spending, the underlying transaction is entirely legitimate, secure, and grounded in real-world personal finance.